Jamie, welcome back. Uh, I've been reading some people that think that Paul's making a policy here to be easing here. Are you in this camp? And what do you think as far as the market's not screaming for a half a point cut like it was last week? What do you think is the Fed's action next week?
Hey, good morning, Dale. Good to see you. Good to see
You
you
too,
guys,
buddy.
and thanks for having me back. And yes, you're right. You can ask me anything. Just don't bank on a coherent answer. But let's give it a bash for the next 27 minutes.
Okay.
Yeah, the Fed next week. I mean, we had, as you saw, the volatility of last week. 50 is it going to be 50, 25? And at one stage last week, according to my calculations, we were looking at a 60% chance of a 50 cut. I did a piece a few weeks ago looking at previous Fed easing cycles, and as far as I can make out, the Fed never really, and certainly in the modern era, if you go from the 90s onwards, the Greenspan era onwards, the Fed has never started an easing cycle with 50 basis points of a first move, unless it's been in a time of crisis, or unless, in the case of I think September 2007, it was well flagged in advance, and the Fed actually had two or three conference calls amongst themselves to decide it. That hasn't happened this time, I suspect, and just going by what the Fed commentary has been over the last week or so, I haven't really seen any indication that they're pushing for a 50, and they seem perfectly comfortable with a 25. I would suggest 25 is probably more likely, and the market's kind of moving in line with that now. Where are we now? About a sort of 60% chance or so, 70% chance of 25. Seems to be more rational, more reasonable. And again, I think if the Fed wanted to steer the market towards a 50, they've had ample opportunity over the last short while, especially on Friday. And had Williams and Waller straight after the payrolls data, which is quite rare to have two such heavy hitters coming straight after such a big number, and they didn't give any real indication that they were prepared to go 50. So I think it probably is going to be 25.
Uh, how do you think the markets are going to react to that? Do you think they're going to be disappointed and people are going to say that, he's really behind the curve? I mean, we have time till the next employment number, right? I think the next big number is the inflation number out later this week. Is it
We've got
PCE?
inflation tomorrow. Is it CPI tomorrow? We've got CPI
Okay.
tomorrow. Yeah, I think. I mean, if you'd asked me that question on Friday, would the market be disappointed? You would probably say yes, because we saw 2.5% sell off on Wall Street, on the Nasdaq anyway. There was quite a big sort of risk off move on Friday on. Um, I think the market was pricing it. It was going between 50 and 25. 50 was going to be, bad news because, what's the Fed seeing that we
I
aren't?
see. Yeah.
25 was going to be bad news because, as you say, they might be behind the curve. I think that was just more to do with market sentiment on the day. But we've seen over the last 24 hours a kind of more reasonable reaction. Risk on's back on a little bit, clawing back some of the moves from Friday. I think 25, if anybody's disappointed or surprised by 25 at this stage, I think they've not been paying attention.
Okay.
Really. I think the disappointment or the shock factor, surprise factor, would be if it was 50 basis points. If you want to look further out, I think that's where it gets more interesting, actually, is what's priced into the rest of the year and into next year.
So
It's
his presser will be very important, more
Well, not
than the
only the
quarter.
not only the press conference, which is always important, but of course we have the revised economic projections on after the press conference or after the decision next week, and they'll be worth watching to see if they raise their estimate for the long-term neutral rate of interest, see what they do with the long-term forecasts for the Fed funds rate itself, the unemployment rate. So they'll be worth watching very closely indeed for an indication of where the Fed sees longer term path of policy. Um, and going by the market reaction, despite all the flip flop between 20 and 25 on Friday, the long term outlook didn't really change much. And I'm looking at the screen now, we're still seeing 240, 250 basis points of easing priced in by the end of next year. That's quite substantial, quite significant amount of easing for if you believe the Fed outlook that they're going to achieve a soft landing. So we've got a huge amount of easing priced in, and don't forget that amount of easing, 250 basis points in what, 15 months. Again, when you look at past cycles, that's consistent with either crisis, financial shock, or episodes of severe disinflation. And there's been 4 episodes in the last 30 odd years when the Fed has cut that much in such a short space of time. Each one has been associated, as I say, with either shock or bouts of severe disinflation. The market is being asked to believe that this time is different. They're going to achieve a soft landing, yet with that amount of easing priced into the curve. Whether the Fed thinks that's a fair amount of easing priced in or not, maybe we'll get an indication next week. But it's a bit of a paradox. And just one further curiosity on that. Even if we do get 240 basis points of easing by the end of next year, that's substantial, as we've just discussed. Yet, it would still leave the terminal rate in just about moderately restrictive territory, going by the Fed's estimates of R-star and where they think the long-term neutral rate should be. So on the one hand, you could get a huge amount of cuts in a short space of time. You think, oh no, what's happening? Where's the economic or market shock? Yet it's still consistent with a reasonably just about restrictive rate of policy. So, raise your money, take your choice.
Okay, what do you think Europe's going to do, ECB, this week? Continue their cuts? The euro has come off a nice rally. We've had a nice rally. We've from 108, 107, and we're pulling back. I'm looking to buy a pullback here. What's your view on the ECB? What's she going to say?
So you're looking to buy the euro here at about, what are we, 110?
Yeah, between 110 and 109. Yeah, in that range. Looking for 115.
Just before I came on, I was looking at the trade weighted euro, not euro dollar or anything, any of the crosses, but the trade weighted euro. And interestingly, it came as a bit of a shock to me because I don't follow it as closely as I used to. But the trade weighted euro 3 weeks ago was at an all-time high, the highest it's ever been since the euro was launched on 22nd of August. It reached an all-time high. So that tells you that the euro on a broader level is fairly strong. It may not be particularly high on certain crosses, but on a trade-weighted basis, it's strong. And you have to wonder if it was to continue rising, at what point would that get on the radar of officials in Frankfurt, especially given where the economy is, where growth is. Inflation already is down in Germany, certainly down below target. It's 1.9%, I think, the last print of annual inflation.
Well, I'm
still a bit higher.
Yeah, I'm kind of thinking, the race to the base has happened in other currencies. I think it's the dollar's turn.
The dollar's turn to go down.
Yeah.
Again, if you look at where the terminal rates are for these central banks, we're looking at 250 basis points of easing from the Fed, another 180 from the ECB, although the ECB has started and will almost certainly go again tomorrow. All that taken in, you're still looking at the Fed cutting about 50 basis points more than the ECB over the cycle.
Okay, so that takes away the advantage of the interest rate differential.
For the dollar, yes.
Yes.
I suppose you have to ask yourself, do you think the Fed will cut over the cycle more, 50 basis points more than the ECB?
Yeah. We'll see.
Given where the economic cycles are, given inflationary pressures, etc. That may be the case, but if you look at certain numbers from the Eurozone, some of the broader metrics, you can argue that growth is slower there. They're flirting with recession, and disinflationary pressures in the Eurozone are probably stronger than they are here in the US. So again, that's one to mull over.
Okay. All right.
But that's on a longer term basis, of course. I mean, certainly in the short term, I think the Fed is certainly priced to move more aggressively in the short term. But if you look toward the terminal rates, then maybe the picture's not quite as clear.
Okay, well, the former President Trump and J.D. Vance are talking down the dollar. And all right, do you know how a executive branch can move the dollar? They can have a view of what they'd like to see the dollar to do. How did they accomplish that?
It's a very good question.
I don't. I mean,
better watch what I say here, I suppose. And sorry, just popped into my head. Just going back to the euro. Don't forget, Europe is much more exposed to China than the US is now. I mean, there's been a gradual shift over the last 10, 15 years or so. The US is much less dependent in terms of trade links than it was, and the eurozone is much more exposed to China. And you don't need me to tell you about the economic problems there and the fight with deflation in China. So if that wind blows from China, I think Europe is probably more exposed. Anyway.
Yeah, I could believe that. And then wouldn't also an appreciating euro also exacerbate the situation for them?
Exactly, which is why I said at some point that has to come onto the radar of the ECB, you would think. But I suppose they've got more pressing problems on their hands right now. But in terms of the politics of the dollar, well, it's an age-old one, isn't it? I suppose I think back to the 90s and the Clinton administration, Rubin as Treasury Secretary. What was his mantra? I can't remember the exact words, but we favour a strong dollar.
Yeah, they've all said that.
They've all said that, but I think under that, the Rubin Treasury sort of hammered that home, and it kind of stuck in investors and markets' minds for, whether it was valid or not, or whether it carried any weight. But whenever our US Treasury Secretary back then said, just a reminder, we favour a strong dollar or a strong and stable dollar, it did have an impact, much less so now. And in fact, as you just said, certain candidates want the opposite of a strong dollar. They want a weaker dollar. And as you mentioned, the race to debase, will that get any traction? I'm not so sure. On the one hand, he's talking about a lower dollar, but then he wants tariffs, and which are probably inflationary. I'm just trying to think through the steps here. And an inflationary environment, then the central bank, the Fed, assuming it's independent under a Trump presidency, and that's another conversation, then the Fed would probably have to raise rates more than it would otherwise do, and therefore the dollar would, catch a bid. So there's lots of circular arguments there. But in terms of what can the administration do, I don't really know, to be honest.
So what do you think is going on?
Tax policy, of course.
Okay.
There's all sorts of economic policies, tax policies to spur inflation or to spur growth that could have, obviously, a secondary impact on monetary policy. Fiscal policy, you could,
how about tax policy, like taxing unrealized capital gains, would create, money goes to where it's treated best. So are people going to want to trade the U.S. market if they're, subject to that kind of rule? I think you'd have to be a U.S. citizen, but that could make other markets that are more liberal be more attractive, and money flows out of the U.S.
Yep, that's certainly possible. Although we'd have to see it in practice. When these kind of proposals are put forward, there's a lot of hot air, and people say, people are going to leave the US. But is that the case? Would that be the case? I suppose the proof of the pudding would be in the eating. Would these multinationals in Silicon Valley and corporate America, would they up sticks and go elsewhere? Possibly.
Okay.
But possibly not.
Do you worry about what's happening geopolitically? Ukraine actually hit Moscow.
I did. Yes, I saw that. Yeah. That's kind of gone off the radar. Certainly from a purely market perspective, that has gone off the radar, and you can argue the rights and wrongs of that. and I'm sure tonight in the debate that will be thrown up again. The geopolitics and markets will at some stage have to pay attention. But I mean, I'm looking at things like euro dollar, treasury yields, Wall Street. I mean, don't forget Wall Street was up until a few weeks ago was at an all-time high.
Yeah.
And yet the Russia-Ukraine conflict is ongoing. There's heightened tensions, to put it mildly, in the Middle East. Political and economic tensions with China. There's Taiwan. And yet, as I say, only a few weeks ago, the Nasdaq and S&P 500 were at all-time highs. It doesn't look like the market is paying those factors much attention. As ever, nobody pays attention until they have to.
Yeah.
And who knows when that will be or what will provoke that change of reaction. But I think you can plan for. I mean, I get in my email inbox just over here hundreds of emails a day, hundreds of emails a week on geopolitical risk. And you guys as traders and investors, you know all about risk. How do you mitigate for that kind of geopolitical risk?
You stay.
I'm asking you.
Yeah,
you can't really do anything until you have to.
Yeah.
Is that a fairly?
You might have hedges on. You might own some gold. You could have hedges on. I mean, bonds have been acting pretty good. Look at this chart, Jamie. It looks to me we're really threatening a pretty important breakout over par and TLT.
But I mean, I'm talking about long-term risks. The threat of, for example, World War III or a US conflict with China, for example, or with Russia.
Yeah.
I mean, that's always a risk. But do you trade on that on a daily basis, weekly basis, a monthly basis? Probably not.
Yeah. But maybe what's happening, I think people are mostly in the market. The high flyers they're coming back, but the Mag 7 took big hits as people were rotating into defensive issues.
It's defensive,
and so bonds have been doing well, gold has been doing well, utilities have been doing well. SPLV, which is a low volatility S&P, they've been piling into. People are positioning for risk off. That's the way it looks.
That's fair. And as you mentioned, all of those are certainly in play, and the bond market is the obvious one. The classic safe haven is the bond market. Do you think the bond market is a bit rich now? I've seen a few notes, Citi amongst others, just in the last few days, saying that they're going tactically short just because it's overbought. Maybe I think the 10-year.
Okay.
On a short-term trade, perhaps, but
here's a 10-year yield. I mean, it's trying to hold this level.
370.
Yeah,
370 in a 10-year.
And that was actually the target off the formation was 370, and it possible little double bottom. I don't think this is a low yet in yields. So I disagree. But what's interesting in yields, what's new, is that we're uninverting.
Yes.
Right, Jamie? So we talked about, attacking this topic, and people said it's really not, people say that's not when we're inverted, that's a problem for financial markets.
It's when it flips.
Yeah. So do you think that this is an important turn?
Yes. I mean, yes. Sorry to interrupt, but
no, go ahead.
Absolutely. The curve, the 2s10s inversion has been classically held up as a signal that recession is on its way. But as you just said there, what signals when recession is more imminent, is when the curve goes back the other way, steepens, and quote unquote normalizes. Like many things, many playbooks, rules of thumb, and economic models and standards, which we held to be true over the last several decades since the pandemic, excuse me, many of them have been either thrown up in the air or ripped up completely. Is that the next one? I mean, is the yield curve
probably
as a signal? Time will tell. But if the disinversion and normalization of the curve still stands as a as a kind of guiding light, then it's kind of hold on to your hats time over the next sort of 12 months or so. I'm just looking as we're talking there, another curve is the difference between the 2-year yield and the Fed funds rate. I don't know if that's one that you follow closely, but that is heavily inverted. Obviously, the 2-year yield has sank quite dramatically. And that inversion is now about 170, 175 basis points, which is the most since 2007 and one of the biggest inversions going back about 40 years. And again, each of those inversions has coincided with quite severe economic or financial shock. So between the 210s normalizing and the Fed funds rate in 2-year going the other way, I think the yield curves are telling us that we're in for a rocky ride in the next 6 to 12 months or so.
What do you think that Jay Powell is thinking? He doesn't have a job if former President Trump wins. So is he thinking about his legacy right now? Could that have influenced why he's acting now? Because it's possible that his term will be terminated by Trump.
Who appointed him again? Was it Trump?
Yeah, Trump threatened to fire him last time. Yeah. He wanted lower rates. He was bullying him and that was during the beginning of I'm not even sure if we were already we weren't even in a tightening cycle, and he wanted lower rates. So yeah, he stated that he wouldn't keep Powell.
Right.
But he changes his mind.
He does. And I think Powell, I mean, if he's thinking politics, then he will probably go 25. I mean, he wouldn't want to do 50 next week, because if I'm right in saying the meeting following in November is just after the election. Is that right? It's the day after.
Yeah, that's right.
2 days after. So he could, I mean, to try and stay apolitical,
right.
He might go 25 next week. And if the market pricing is correct, 100 bips by the 110 by the end of the year, that implies that at least one meeting must have at least 50 basis points of cuts. Right. He might save that till after the election. In terms of his longer term legacy, I did a piece about a year ago or so, just throwing out the question, not saying either way, but just raising the question: if the Fed can achieve a soft landing without recession and a huge spike in unemployment, would Powell go down as one of the most successful Fed chairs in history? We'll throw that open to you. And I think if he manages it, obviously people say Volcker, many people say Volcker is the greatest Fed chair in history. Of course, his action came with a heavy price in terms of unemployment and recession. If Powell manages to get the soft landing this time around without a recession, I think that would be his legacy. Whether or not he's fired a few months after by incoming President Trump, I'm not so sure. Again, I'm not saying he would be the greatest Fed chair in history. I'm just throwing it out there as a question.
Yeah. So he could save his bazookas for after the election. He could lower expectations by going a quarter, and then after the election, if we'll have more employment data,
more employment numbers, and we'll have again going back to the SEPs. The staff economic projections, they'll be revised next week as well, and they'll give an indication as to the longer term thinking of the FOMC and what we can glean about the policy path from that. So yes, more employment data and the SEPs.
Okay, you know what I'm most concerned about, Jamie, is there's not a growth engine to pull the world out of any kind of recession. In 2008, the Great Recession, China was still growing. Mm-hmm. And I think they were a big factor in helping us come out of it.
Absolutely.
Okay, the world, right? So perhaps the opposite is happening now. They were able to drag us into it, out of it, and they're dragging us into it.
Well,
starting with Europe.
Huge engine of recovery back in 2008, 2009, most certainly. And let's not forget the trillions of dollars of Fed and Eurozone and G10 stimulus, whether it be monetary and fiscal. That certainly helped, as it did after
Yeah.
the pandemic. But you're right, China's no longer that engine of growth that it once was.
There isn't one, right? Europe, Asia's,
No,
Latin
no.
America,
Which is
nowhere.
why we may be, we've been saying it for many years, and when the push comes to the shove, it may turn out to be the case. But we're all turning Japanese in a way, aren't we? Because if we do go into recession or downturn and there's no obvious way out of it, it's back to fiscal and monetary policy, isn't it? So
Yes. Okay.
fiscal spending, despite the all the problems that entails, and if the Feds, I think, again, I keep banging on about it, but one of the big lessons from 08 and 2020 is if in needs in times of crisis and there's no other option, the Fed's going to step in.
Okay. All right. Well, that's my takeaway.
Go big, and ask questions later. I think that's what 08 and 2020 told us, and I don't see any change in that mindset from the Fed.
Okay.
If the situation requires it, I don't think we're anywhere near that just yet. But if there was to be another crash, they would go big again and ask questions later.
We're all turning Japanese by Jamie McGeever.
Of course, the irony being that is the BOJ now is moving the other way. They're finally,
right.
after 20, 30 years, starting to tentatively take the first steps towards normalization, but they're doing it rather cautiously, understandably.
All right. Well, you guys just had a taste of what you could get if you go to Jamie's writings. Is there a specific place on the website for people to go to, Jamie, to get your articles, or do you tweet them out there? What's the best way for people? What's that? Reuters.com.
Reuters.com, yeah, and just
okay. Is any of it free?
All of it's free.
All of it's free. Okay.
On the website, on the Reuters.com website, all free.
All right, Jamie. Well, there you go. So I bring Jamie in because I think he's important for us to have a grasp on what's happening with the Fed. And interesting interview again, Jamie. You always come through. So it was really.
Thank you very much, Dale. It's fantastic to be back as well. And
yeah, I always enjoy your giving spirit to come here and edify our community. We're grateful for that. So best to you, and you and I will be talking after the Twilight Zone election in December.
Yes, I hope so. I hope so. I'll be glad to come back if you'll have me.
Yeah. Yeah. All right. Jamie McGeever, everyone, and you can follow him on X at Reuters Jamie. Go to Reuters.com to keep in touch with what Jamie's thinking. Take care,
Thanks
my
again,
friend.
Dale. All the best, everybody. Bye-bye.
Thank you. Jamie McGeever, everyone. That's a wrap. You can join the team in 15 minutes on the Morning Edge. Good hunting today, everyone. See you tomorrow. Don't just count your pips, count your blessings. Adios. Thanks again, James.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.